Hey, everybody, welcome back to the Retire While You Work podcast this week. Once again, Myles Zuger, advisor here on the team, joined by Carson Odom, another advisor here on the team, and also CPA, which very relevant to what we are going to be discussing today. It's that time of year when everybody's scrambling around, uh, asking for tax documents, just doing some planning, if you can do some carryover planning from the previous year. And so we thought it'd be relevant for us to talk taxes at a high level this week. Again, we're not accountants. Well, I guess Carson technically is, but we're not practicing accountants doing tax work every day. But being a CPA, David being a CPA, Carson and David obviously have a very good um, tax understanding. And I've certainly learned a thing or two from them, and just haven't done this for 10 years, about how taxes can impact a financial plan also. And so we just wanted to have a short discussion on some proactive items you can do for tax planning for the current year, for the previous year, and just how to think about taxes overall in your financial plan. It's certainly a relevant thing when you're investing to consider taxes. And I think our best clients, some of the best relationships we have, are those where we work pretty closely with their CPA or their tax accountant, so that the tax side of the plan is talking to the investment side of the plan, and everything's working together in sync, and for the greater good of the overall financial plan. So as we get started here, Carson, just tax season's upon us. It's this recording March 19th. Tax day is obviously April 15th if you file on time, or later if you file an extension. And so a month out here, what should people be doing?
Well, it's very fitting because I pressed submit on my tax return this morning. I file it myself. Still pretty simple, so I still feel confident enough to file it myself. I think, at this point in time, at the time of this recording, March 19th, if you haven't spoken to your tax accountant, whether or not you're going to extend or file, and just so everyone knows, April 15th, that is the time that taxes are due, regardless of if you extend your tax return. So realize that taxes are still due on April 15th.
The tax payment you're referring
The tax
to.
payment, yes.
Yep.
Your taxes for the 2024 or the prior year tax year are still due on April 15th. The extension is only an extension of time to file your tax return.
And what happens if you miss? So penalties, correct?
That's right. So if you don't pay your taxes on April 15th, or if you extend and then you file October 15th and you owed a little bit more, you owe penalties and interest on the amount that you did not pay to the government, because your taxes are still due by April 15th. And sometimes people can get a bad rap about filing an extension. There is literally nothing wrong with filing an extension. To what I've seen and heard, it's not like it's an automatic increase in your chances of getting audited by the IRS. It is truly just extending time, because sometimes you don't get a form in time, that sort of thing. It's no big deal to extend your taxes. Just if you do, know that the tax payment is still due on April 15th. Come tax time, my biggest recommendation to people is please start early, whether or not you're doing it yourself or doing it with an accountant. A lot of accountants and accounting firms have deadlines. Like, if you don't have your documents to us by March 1st, then we're just going to automatically assume you're extending, because it takes time. And sometimes you have to do corrections before the deadline. Meaning, if you contribute to an account you shouldn't have contributed, you need to back it out. That has to be done by April 15th. And if you're letting someone know on April 15th, hey, we need to get this form signed and get, all this stuff processed, might not happen. And it was just because of a delay of starting your taxes. I think there's nothing wrong with, as forms come in, go ahead and upload it in your tax software, go ahead and send it off to your accountant. You can't be too early with this stuff. You're only going to be mad at yourself if you start late, and then it causes the chaos that everybody knows about April 15th and trying to get your taxes filed. But it's an important time. And I think a lot of people, when it comes to taxes, always think retroactively. But the biggest thing, you can do a lot of planning, and you can have a lot of conversations in the current year for the current year, the current tax year. Don't wait until April 15th to have a conversation with your tax advisor. Reach out on June 15th in the middle of summer when there's not a lot of work going on, so that you can proactively have conversations instead of having conversations looking retroactively and being stressed out about it.
Yeah, I think that's smart. And I think kind of going hand in hand with that, I think a lot of people only think about taxes this time of year. It's like like thinking in the current 2025, people are working, they're making money, not really thinking about taxes for this year. And then come 2026, they'll be like, oh, all right, it's February, time to start working on my taxes. And so, for some people, and I think for most people, taxes really should be like a year round thing that you're reviewing, going through, talking with your CPA, because you can be, to Carson's point, you can do some proactive planning this year, and you can do quite a bit, whether that's making contributions to retirement accounts or HSAs, or reviewing Roth conversions for, that'd be for current years, but doing those types of things based on income. You can do all that. But if you're talking to them all the time, you can also do a lot of planning ahead of time also to make sure that the plan's working efficiently.
Yeah, I think there's some stat that we had that was looked up according to planadvisor.com. Nearly half of people only think about taxes during tax time. So it's like there is this entire year that sometimes you're not even thinking about taxes, which taxes aren't everything. You shouldn't be thinking about them every day. There's lots of things that have to be done in the tax year. So, like, for example, charitable contributions have to be done in a calendar year. You can't come tax time say, oh, I'm going to retroactively contribute to this charity for the prior year tax. No, you can't do that. It has to be during the calendar year. Myles, you mentioned Roth conversions. Roth conversions, they have to happen in the calendar year. There's only things like that have to happen in a calendar year, and you have to be proactive about it. You have to be having conversations in the year before the end of the year in order to make those conversations. Like expenses for your business. If you're trying to write something off, you can't go, buy a car on March 1st and deduct it for the prior year. No, that has to happen in the calendar year. That's why you always hear the stories of, oh, it was December 31st and my accountant told me I'm making too much money and I got to go buy a car. So I had to go to the car lot and buy $100,000 car. Well, it's because deductions only happen in the year in which they take place to a certain degree. But do planning, do proactive planning. Now, there's always some things that you can do come tax time when you're filing your taxes. You can make prior year contributions for an IRA, or you can make prior year contributions for a Roth IRA or an HSA. You can do prior year HSA contributions. But it's better to do those things proactively. But like SEP contributions, generally with clients, when it comes to a SEP for clients who are self-employed, there's a very specific amount that you can contribute to a SEP IRA. You're limited based on your income, and nobody knows exactly what their income is going to be. So a lot of times we'll recommend waiting until you file your tax return so that we can know exactly how much you can contribute and we don't over contribute. Otherwise, you got to back it out and all this complicated.
And I think saying kind of on the planning thought there, even if it's not like actually taking the step to like proactively do things, I think early on, the year gets long. Like the year, it's long and it's fast and short at the same time. So it's like, it's easy and hard to plan. So I think if you're maybe not taking a lot of action right now, but you're meeting with us or somebody like us that you work with or your tax person and saying, hey, I think my income is going to be about X this year. Or for maybe some reason your income is going to be down this year. Starting to plant those seeds so that come October, November, December, towards the end of the year, when you start to have a better idea of what the year is going to shape up like, you can start to take action on those things. So planning doesn't mean it has to get done right now. It means let's start having these conversations. So come last half of the year, last quarter of the year, we can then start taking actions on those. And it's already conversations we've had versus over time versus having to start from scratch then and look back all the way across the year. So a lot of things, again, just because you're planning doesn't mean you have to do it. It's just about getting ready to take that action come the back half of the year.
Yeah. Same thing with, and investments too. Like with your investments, they're a calendar year thing. So a lot of times we talk about tax loss harvesting, especially in the market's volatile, kind of like it's been this year. If you've recently been invested in the stock market and have started buying, your positions might be down. Opportunity that could come up is tax loss harvesting, where you sell one position, buy into a similar but different position, take the loss, but stay invested. And those are things that we're doing proactively for a lot of clients. Now, just because the market's down doesn't mean you have the ability to be to tax loss harvest, because if you bought into the stock market 10 years ago, then your position is going to be really appreciated, and it might only be down just a hair from all the appreciation you've already had. So it's not always an opportunity to tax loss harvest, but it's something that you can do. Otherwise, if you're a highly compensated W-2 employee, at the end of the day, there's not a lot of things you can do to save money on taxes. It's just the unfortunate spot where you've got a high W-2 income, you're maxing out your 401k, hopefully. If you're HSA eligible, you're putting money in your HSA, you've tax loss harvested, you're being as efficient with your investments as you can. Other than that, there's not really too much else that you can do. It's just an unfortunate spot. And just what I like to say is just don't look at your total tax on your tax return, because it's might be a little bit depressing. And just know that, we get questions sometimes, or from a client or a prospect or somebody that's like, how do I save money on taxes? I'm paying too much money in taxes. There's no way I need to pay this much money on taxes. Well, it is what it is. I mean, they're gray, but at the same time, they're black and white. There's no just magical missing deductions out there. And if you take something really aggressive, then I think the IRS might come knocking. So
it's almost like the IRS likes to put you through the pain of just seeing that number. I think I saw online one time, it was like, the IRS knows down to the penny what you owe them, yet they still make you go through doing taxes and you confirming that, I guess confirming that for them. So it's like, we also hear that. I mean, that they already know that. They could just ask you to pay that, yet the tax code is thousands of pages long of actually how not to pay taxes.
Isn't it like 10,000 pages long or something?
Yeah, we were talking the other day. It's very long, and only like a very small percentage of it is actually what you owe, or like what you're going to owe. And so I think, working with a good CPA who can help you find all the deductions that you're legally eligible for, not trying to skirt the tax code, but deductions that you are legally eligible for, and able to get those, as well as tax credits that you may be eligible for, whether it's the child tax credits or some other tax credits based on where you live, electric vehicles, etc., and really taking advantage of those in an effort to reduce tax liability as you can.
So my friend Google told me that the IRC, the Internal Revenue Code specifically, is about 4,000 pages long. But if you include regulations, tax rulings, case law, so on and so forth, it is tens of thousands of pages long. So essentially,
then your individual tax rules, business tax rules, like all those types of
trusts,
corporations,
that includes everything, which just goes to show it'd be wonderful to have a very simple tax code. It comes to the government and filing providers that are out there, they absolutely love the fact that the tax code is complicated, because that's how they earn their wage. And I think from a basic consumer level, it'd be great if it was simple, but we're so deep into how complex taxes are that I think it's probably always going to be this way. It's never going to be so simple. I remember one of Trump's campaigns back when he was doing the Tax Cut and Jobs Act in 2017, 2018. He was like, you can file it on a postcard. And essentially what he did was, the first page of a 1040 tax return was cut in half. It was smaller. And I think whenever I looked at my 1040 for this year, it's back to a full page, and there's just as many schedules and things that you have to fill out nowadays. So it's still just as complicated, and there's a bunch of pages. And I think it's always going to be that way. But when it comes to, bottom line, when it comes to taxes, I think be proactive. Do what you can during a year. Have a check-in with your accountant and say, like, hey, on my W-2, am I having enough taxes withheld? They can run a very simple calculation to see if you're under or over withheld. So you can know. A huge refund for some people, they like it, but also at the same time, you're giving the government thousands of dollars for free throughout the year that could be in your pocket to help with your budget on a monthly basis. I think hitting zero come tax time is close. Like, not to get too personal, I owe like $400 on my taxes this year. To me, slam dunk. That's perfect. Like, that means I wasn't super over withheld and I'm getting a huge refund, but I also don't owe a bunch of money. I get into the weeds a little bit to try to figure out how much taxes I'm going to owe by the end of the year, and I make sure I'm paid in enough. But I think that's a huge win. That means I maximized my net income that I had throughout the year, and I wasn't giving the government too much or too little. And then I'm in a spot where I owe a bunch of money come April 15th. So I'm thankful it's right at a small amount. But have a check-in with your accountant, have a conversation with your advisor, have a conversation with us to talk about your taxes, to review your tax return. Again, we can't give tax advice. We're not practicing CPAs or accountants, but we can at least work with your accountant. We can at least talk tax, big picture, and how it relates to your financial plan. But the bottom line, you got to be proactive with it. You can't be, trying to make decisions on April 15th before midnight.
Yep. Another thing I think to mention is for those going through a transition, maybe it's retirement, change of jobs, whatever it might be. It's always a transition period of like what your taxes are going to look like, especially for people who are retired. Maybe you're used to making 6 figures plus at your job, and now you're retired and you're going to be living on Social Security, maybe a pension, a little bit from your investments. There's always, I like to tell people, there's always probably a year, maybe even 2 or 3 until we really get that dialed in and know what it looks like. And so you can plan, you can do all that. There's always going to be changes to your circumstances that change what you're going to owe in taxes. Maybe tax rates go up, maybe tax rates go down. Probably unlikely they go down, but kind of just bringing it back again to the planning. It's the biggest and best part you can do for a financial plan is to make sure that the tax side is speaking to the investment plan and that you have a team working for you, working together to have it all in place.
That's right. Yep. Last little tidbit I would say is, as you're doing tax planning, it's impossible to know where tax rates are going to be in the future. Truly impossible. I think, historically, we're in a relatively lower tax rate environment. Taxes aren't as high as they've been before. And where are they going to be 10 years from now? Absolutely no idea. You've kind of got to make decisions based on the current environment that you're in. You can't necessarily say, where taxes are going to be higher in 20 years. Maybe not. Just make decisions based on the current tax environment. Don't try to overthink and make decisions on where you think or feel taxes are going to be 5, 10, 15, 20 years from now. You just got to plan on what's going on right now. Now, if the writing's on the wall that, the estate tax exemption or whatever is going to be cut in half, then yes, you've got to do some proactive planning. Or if the writing's on the wall that all of a sudden tax rates are going to double, then yes, you've got to do some proactive planning. But just go off the expectations and have conversations of what reasonable expectations are from your tax accountant or advisor.
Yep. And kind of to sum it up, end of the day, if you are paying taxes, it's not the worst thing. You're prepared for it anyways, hopefully. And you should never make, unless there's big changes coming along, to Carson's point, average year, you should never make big decisions related to your financial plan just because of taxes. It's definitely something to take into account and to consider, but it should be considered along with all the other things. And if in the end it says, hey, I'm going to owe X amount in taxes to do this, but I understand that and I'm okay with that, go that decision. Don't make the decision. Make the decision that's best for you personally, from a financial plan, for your family. And if that is a plan that involves the tax side, perfect. If it's a plan that maybe involves paying a little bit more in taxes, but it's the best decision for you and your family, go that route.
Don't let the tax tail wag the investment dog. If you're paying taxes, you're making money, and you obviously don't want to pay any more taxes than you should. Kind of 3 things to sum it up right there.
Yep, I think that's good. I think that's a good way to end it here. So thanks everybody for joining us on this week's Retire While You Work episode. It's that time of year, tax time. So do some planning with your advisor or your CPA, and we're here to help if we can do so in any way. Thanks.
See you next time.
Any opinions are those of myself and not necessarily those of Raymond James. Expressions of opinion are as of this date and are subject to change without notice. The information contained in these podcasts do not purport to be a complete description of the securities market or developments referred to in this material. The information has been obtained from sources considered to be reliable, but we do not guarantee that the foregoing material is accurate or complete. Every investor's situation is unique, and you should consider your investment goals, risk tolerance, and time horizon before making any investment. Prior to making an investment decision, please consult with your financial advisor about your individual situation. Any hypothetical examples are for illustration purposes only. Actual investor results will vary. Raymond James does not provide legal or tax services. Please discuss these matters with the appropriate professional.